Hey everybody, today is Wednesday, the 1st of May, 2024, and the Federal Reserve met today, and we saw an initial buying flurry here, but that was quickly faded, and we closed right near the lows of the day. The old phrase, from failed moves come fast moves. That was a failed move higher, and we got the fast move lower. We're below a declining 5-day moving average. We're below declining 20-day moving average. The 50-day moving average will start to decline in the next day or two here as well. So you've got to be really cautious in here. If you're looking to buy things for anything more than a day trade, I think you're just plain wrong. We're at the year-to-date anchored VWAP. That has held so far for the most part, but the more times any level of support is tested, the more likely it is to fail to hold. This is looking kind of like a bearish flag here, and if you look on the shorter term time frame, it kind of seems like that bearish flag has broken. That might indicate the height of the pattern, which is from 525 to 495 from this high point here, could suggest down near 485 or so. I'm not calling that, but I'm certainly saying that it's a possibility, and that you've got to be quite defensive in here right now. In regards to the S&P 500, it did fail right where it was supposed to, the level we've been talking about for the last week and a half, which was this prior band of support, the anchor from the all-time high, that's that red anchor, and from the 20 and 50-day moving average. So the market is doing what it's supposed to do. Now, the action today reminds me of the phrase that I'm going to say if you've listened to me for a while, Linda Bradford-Rashke's quote, which is, the markets will do the most obvious thing in the least obvious way. The most obvious thing for a market below a declining 20 and 50-day moving average to do is to continue lower. What's not obvious is these types of moves of how they do it. A 9-point rally in your face that then just gets stuffed here is not a fun way to deal with a bearish position, although the bearish position, if you came in yesterday bearish, you were correct. Now, the journey to correct was short-lived in the morning, and then you got a reprieve here. But to me, that's not low-risk trading. That's what I'm looking to do. Now, for the NASDAQ, we're getting stuck at not only the declining 20-day moving average, the anchor from the all-time high, the declining 50-day moving average. You can see now we got rid of this data today and replaced it with this data. That's why that 50-day moving average is declining. So we've got a declining 20 and 50-day moving average. What we have to do is say, what's the next potential level of support? Is it an anchor from this low? No, because we've already violated that and we're through it. So how about from this gap right here? Is that? Well, that's exactly where we are. That's where we've tested previously, and it's certainly a level of interest. But am I going to buy here because it's touching this anchor? Not a chance. We've got a declining 5-day moving average. We've got massive volatility in here today, and I think you've got to, smart money lets it settle down. There's no hurry to get involved. If you're a day trader, completely different story. But it seems to me as though the lows from last October will be tested again in the NASDAQ. That would bring this down to about 414 rather and a half. And there's no guarantee there's going to be buyers there. It's just a level of interest that kind of allows us to have some structure around our analysis. The Russell 2000 also finding supply exactly where it's supposed to. The declining 20-day moving average, the year-to-date anchor, and the anchor from this year's high, that thick red line. So, to buy up in here just doesn't make any sense. And to get suckered into these rallies, well, guess what? You got suckered. That's it. Don't shoot the messenger. It's just a fact that when we have a declining 20 and 50-day moving average and declining 5-day moving average, you don't look for rallies to hold. You've got to be super defensive and understand what the market is telling you. For now, it's telling you stay the heck away from the Russell 2000 as well. I wouldn't be surprised at all to see it test the 200-day moving average and maybe even last year's anchor at some point here in the coming weeks. Some of you who like patterns might call this a shoulder, a head, and this a shoulder. If that's the case, well then, that projects bearishness as well. You could look at a Fibonacci and say, where are we right now? Well, so far, from the low of last year to the high of this year, we've come down and tested the 38.2% retracement. A 50% retracement would bring us down to the anchor from the beginning of last year. All reasonable levels. I'm not so much focused on where it's going, but how it gets there and how I can control the risk on a shorter term time frame. This volatility over here says just leave it alone for a little bit. Let it set up in a more sane way. Now, the semiconductors came right up to the week to date volume weighted average price. That 5-day moving average is flattened out and rising a little bit. Tomorrow we get rid of this data, meaning as long as we're below this level, we'll start to see that 5-day moving average flat decline. We've got a declining 20-day moving average. The 50 will still be advancing as long as we're above this level, but that's in jeopardy. So that's going to start to decline here shortly as well. We've tested the year-to-date anchor. No guarantee that's going to hold again. So I think the main message of the market is to be very defensive. Now, the one group that did hold on to some gains today was the Biotech. So we were looking for a little bit of a pullback from this level up here, and then a resumption of strength. We ran up to it, caught a little bit of a higher low, and then it broke higher. I wasn't watching it. I called this, but calling it, that's different than trading it. I'm not interested in my calls. I'm interested in making money. So I completely missed that one. If you're involved, it's still a counter trend trade with a declining 20 and 50-day moving average. Your worst case stop should go under here. This is the most recent relevant higher low. If you bought today and you allow it to drop down below that level and you take a loss, you deserve that loss. You accept being a loser in the market. You listen to the definition of trend: higher highs, bang, higher low. If it breaks that definition and you're still holding on, you get every loss that you deserve. Just as when you protect your gains, you deserve to hold on to those. It's not meant as criticism. It's tough love. It's reality in the market. This is about making money. Let's talk about the cryptos. Bitcoin, a week and a half, or I guess last Friday, I had outlined that I was not feeling good about this. I thought maybe that what was going to be the scenario is we come down and test the anchor from this year-to-date low, get a little bit of a bounce, then come down to the year-to-date anchor. Well, there was no such bounce there, and there was no evidence that buyers were in control on the shorter-term time frame. Let's take a look at the 10-minute time frame. No evidence in here the buyers were in control. Those drawings spilled over. So let me see. Can I delete that easily? I don't know how to do it on this actually right here. So we didn't even make it up to the 2-day volume weighted average price in there today. So sellers are still in control of Bitcoin. I'm not calling this anything other than a level of interest. What I did on Twitter today was I posted a chart with a volume profile on here. Look at how little amount of volume has traded in this area here. Perhaps the next drop is down towards this level, down near 52. Below that, we have the year-to-date, the 200-day moving average and the anchor off of last year's lows. Those are all, within reason to decline to. If we drew a Fibonacci off of that low to this high, well, that would bring us to a 50% retracement of this bigger move. So Bitcoin, I'm not bullish at all. I'm not bullish on Ethereum. We had drawn in a trend line. Let me see if I can do that here. We had drawn in a trend line off of these lows, and breaking a trend line doesn't mean a reversal. It means the rate of the prior trend has slowed down. So maybe we get a little bit of a bounce in here before we can either recover, unlikely, or we drop down further towards that 200-day moving average and the anchor from this low right in here. So I think that this is the key level for Ethereum, 26,700. And until then, until it gets there, just basically leave it alone. I don't understand why people want to buy things in downtrends. It's always a mystery to me. Financial stocks are still pulling back here a little bit. They've got a declining 5-day moving average. Maybe they can straighten themselves out. It doesn't seem like it, not with this failed move here at the end of the day. I'm looking at it thinking that it's most likely going to test the year-to-date anchor. We have what's looking like a lower high right now. What would ruin this market is a lower low. Now, I wouldn't short below here. That's just dumb because it would have just dropped from 41 and change down to 39.5. Instead, if it breaks that and then rallies up, then the next decline, as it starts to roll over, here, the question is, would you have held it today? I don't trade the financials. I don't know. Energy names have been broken. They are best left alone for a while. No point. We spoke about, worst case stops go underneath this low. That was violated. There's no reason to hold these trades any longer. They're going to need some time to heal. Silver still broken. Gold still broken. There's just not a lot of bullishness out there.